The rise of a banking ecosystem. Introduction. An indelible, haunting reminder of bank failures. In April 2007, New Century Financial Corp., a leading subprime mortgage lender, filed for bankruptcy. Shortly thereafter, many subprime mortgage-backed securities were downgraded to a high risk. On August 10th, 2008, Henry Paulson, the U.S. Treasury Secretary, said, "I don't think the subprime issue imposing a serious problem. I think it's going to be largely contained." But he underestimated the crisis severity. The total cost of year 2008 subprime crisis was $2 trillion lost in global economic growth, $16 trillion loss in household net worth, with the U.S. unemployment rate reaching 10%, $498 billion of direct cost of bailout, which accounted for 3.5% of the U.S. GDP in year 2009. The subprime crisis left an indelible, haunting reminder of bank failures that persist even today. I want to ask, what is the root cause of bank failures? How has our banking system changed? What will it be like in the future? What should community financial institutions to do? My name is Tom Ho. In this talk, I want to answer these questions based on my 40 years of experience. I received my PhD in mathematics and taught for 10 years at the New York University as finance professor. My research contributed to innovations that are widely used in balance sheet management. I co-founded a global company providing fixed income portfolio analytics system for some of the largest financial institutions. I was a retained senior consultant in one of the largest insurance companies. My company was a sole provider of the risk report for banks under a federal bank regulatory agency. My current fintech company provides financial analytics solutions to many financial institutions. For this talk, I will draw upon my experience in academic research, entrepreneurship, large financial institutions, bank regulatory agencies, and community financial institutions. Without further ado, let's get started. Part 1. A root cause of bank failures. In 1781, Alexander Hamilton, a founder of the United States, established the first bank of the United States and bond trading. He laid the foundation for the young nation's financial system. He identified the necessity of the symbiotic relationships between the financial institutions and the capital markets. Financial institutions and capital markets facilitate the flow of funds from lenders to borrowers. Today, the United States has become the leading global financial center. The U.S. banking system has evolved into a network of numerous institutions and government agencies. There are over 8,000 depository institutions and many financial services companies. As of 2023, the global fixed income market was $768 trillion. Financial services constitutes 9% of the U.S. GDP of $29 trillion. The U.S. has become a bedrock of international financial services. Since their founding 240 years ago, the banking and the capital markets have grown intricately related, sustaining many external and internal shocks, such as wars, depressions, technology's relentless progress, financial scandals, game-changing innovations, and political challenges. This has led to two consequential changes to the banking system. Generally accepted accounting principles, called GAAP, and the regulatory framework. Regulations ensure the bank's safety and soundness and facilitate the efficient flow of funds through deposit insurance, securitization, and liquidity facilities. Regulations focus on measuring, managing, and monitoring risk exposure in banking. However, this focus is only tangentially related to the pursuit of profitability. Banks are private enterprises whose management focuses on profitability, which is mainly based on accounting. GAAP ensures the standardization of performance measurements across institutions, not just banks. And GAAP-based profitability is only tangentially related to risk management. But here is the problem. Accounting is based on a single scenario framework, devoid of risk modeling. On the other hand, risk modeling must be forward-looking and based on multi-scenario simulations. These simulations are helpful to public policies, regulators, and risk managers within the financial institutions. This incongruence between profitability and regulatory process create problems. Part 2. Misalignment between accounting and risk management. Regulatory and management goals are misaligned. On the one hand, management must seek stable and growing earnings. On the other, it must meet regulatory requirements. Tension within the banking process grows with complexity. It results in a fragmented mix of lending, treasury, risk management, and financial reporting that become siloed to meet various stakeholders' needs. The siloed approach across business units is a key reason for bank failures. This fragmentation creates a significant deadweight loss for a bank and the banking system. One consequence is the misalignment of incentives between bank management and regulators. This challenge is further amplified by the bank's asset liability management system, many of which have evolved from an accounting framework. They are almost devoid of risk analytics such as option pricing and risk premiums. Meanwhile, the regulatory risk diagnostic tools remain accounting-based to align with the management accounting mindset. For this reason, risk management inevitably remains peripheral to the primary banking process, the process of making loans and financial reporting. The primary banking process is anchored on loan origination and financial reporting and often excludes risk management. Risk management augments the primary process at best, but is often treated as an afterthought, checking the boxes. These checking of the boxes are established by policy for the regulators and the regulated. They can be binding on bank executives and private sectors and on regulators in the public sectors. They are guardrails for the banks. The cost of misalignment of incentives was on full display in 2023. The collapse of Silicon Valley Bank, First Republic Bank, and Signature Bank underscores the siloed banking process as a root cause of bank failures. For example, before its collapse, Silicon Valley Bank reported robust financial performance, with total assets of $209 billion and net interest income of $3.8 billion. However, the bank had significant unrealized loss and could not afford to raise deposit rates in the rising rate environment without wiping out its margin. Under this condition, it could not raise additional capital and led to its collapse. The lesson learned is that the bank may report adequate financial performance, but may fail to consider the appropriate risk and return trade-off. Yet, market participants must provide solutions. This economic deadweight loss is unfortunate and dangerous. The crisis could have been prevented if the market had recognized the seriousness of incentive misalignment. This misalignment cracked the bedrock of an economic system first laid down by Alexander Hamilton, the symbiotic relationship between capital market and financial institutions. Part 3. The rise of risk models. To underscore the complexity of resolving this in 60 years of history, to the initial development of the banking ecosystem. The rise of the banking ecosystem began with the quantification of risk, something that this accounting framework remains ill-equipped to address. In 1952, Markowitz, modern portfolio theory, introduced the approach of risk and return trade-off. In 1965, Farmer's efficient capital market hypothesis laid a foundation for financial valuations. In 1961 to 1966, Sharpe and Littner capital asset pricing model quantified the risk premium of risky assets. 1973, Black-Scholes-Merton introduced dynamic hedging in pricing options. These founders of modern finance were awarded multiple economic Nobel Prizes. Interest rate deregulation in 1973 ignited explosive growth in financial modeling, and these founders' contributions established a capital market paradigm. They provide a standardized financial instrument valuation framework, and the framework results in price and operational efficiency. By contrast, if lending, risk management, treasury, planning, and financial reporting had their own valuation algorithms, then the banking operation would be prohibitively inefficient. The modern valuation model can be applied to the balance sheet management. In 1984, Holy model extended these methods to fixed income instruments to achieve broader applications. The valuation model can be significantly more accurate for fixed income instruments than the capital asset pricing models for equities. It becomes forward-looking based on market expectations, making it an indispensable risk modeling engine. Fixed income modeling led to market risk analytics such as option-adjusted spread, key rate durations, and fund transfer pricing curve, which is an actively traded yield curve such as the Treasury and the swap curve. The concept of fund transfer pricing curve, a liquid yield curve, is central to the dynamic hedging of Merton Black-Scholes model. Valuation fails to be effective without liquid capital market instruments. These models show the option-adjusted spread is in fact the profit release when risks are managed. Therefore, fixed income models can bring valuation, risk, and profitability together in one consistent framework. This approach can eliminate the siloed effect in financial institutions, potentially eliminate the incentive misalignment. Part 4. Analytics fueling risk management. Fixed income analytics are central to managing risk. This cannot be overstated. At the same time, accounting mindset hinders risk management progress. This cannot be underestimated. All banks' decisions involve risk and return trade-offs. Risk must be managed in the capital market because balance sheets, by definition, cannot function as a closed system, isolated from market, customers, competition, bond and loan and funding trading. Banks have corresponding banks. Federal Home Loan Banks have members. The broker-dealers have customers. They all belong to a bank ecosystem. Fixed income analytics let them share the risk management tool, calibrated to the standard capital market. Accounting lets them standardize their financial reporting. Options are embedded in mortgage prepayments, callable and puttable bonds, loans and borrowings, and structured derivatives. Since options model pricing is common accepted practice in the capital market, these risk models standardize risk management tools and form the banking ecosystem foundation. By contrast, accounting approach fails in valuation and risk analytics. Based on subjective model assumptions, isolated from any market value of risk, this process ignores 60 years of settled risk management development. Based on an academic accounting framework, banking decisions have no market reality check. It is no wonder that some chief financial officers often ask, "Am I flying blind?" The success of fixed income valuation modeling led to the implementation of market-to-market models, as opposed to mark-to-market, for inactively traded instruments on the balance sheet. Fair value accounting level 2 allows instruments to be valued relative to similar instruments by applying the calibration methodology. In 2012, interagency guidelines introduced economic value of equity, EVE, in risk regulatory reporting, requiring regulated institutions to measure the EVE of the balance sheet, directly relating capital market information to regulatory purposes. Over the past half-century, financial models have quantified risk measures used in accounting and bank profitability in one coherent framework. However, quantification remains siloed because of the accounting legacy embedded in many asset liability management systems and the cultural inertia of senior management risk management background. Risk management often remains an afterthought despite the availability of risk quantification tools. Incentives remain misaligned and continue to be the root of the bank failures. How can banking system and bank overcome the incentive misalignment?